Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax efficient or tax free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no cost, no obligation consultation with me. Enjoy.
Tonight, we're going to talk about the 4% rule. The 4% rule is something that came about many years ago. I'm going to talk a bit about history, but it's really surprisingly still active out there in the financial planning world as a rule of thumb for drawing down assets. So just raise your hand for me if you've ever heard of the 4% rule. Let me see a raise of hands. Yeah, so quite a few of you. Familiar faces and names tonight. So the oh, and I'm sorry. Let me go back and do our housekeeping here. So I want to remind you that you are all muted. There is a Q&A section at the bottom of the screen that I believe you all know how to use. Chat is disabled, and this will be recorded. I'll give you an update. We have many videos on our website that we're adding. We're adding them every single day. So please take advantage of the videos on the website. The weekly webinars are starting to populate up there so you can view them at your leisure. And let me know what your thoughts after you take a look at them. So as I said, this is the final webinar for July, and then we'll have another one August 25th. So back to the 4% rule. So many of you heard about the 4% rule, and what does this rule, whether it's it makes sense or not, what is this designed to cover? So it really is designed to cover longevity risk. It attempts to answer the question, how long will our funds last? All the funds that we've saved for, may sometimes sacrificed for, invested for, all the money that we scrimped and saved and put away. How long can this last during retirement, and at what rate should we withdraw those funds to last for our retirement? And that is the question about longevity. How long are we going to be here, and how much can we fund? Now, remember the 4 risks that really cover most retirees for sure. And we talked about those yesterday on our webinar, and they are market risk. That's obvious. The risk that the markets are going to drop and you won't have the funds that you need to draw from. Long-term care risk, and that's a concern that you're going to need long-term care sometime in the future, and long-term care is unbelievably expensive. And if you're going into retirement as a married couple or a partner or whatever your situation is, we know statistically that you have a 70% chance of one of you needing long-term care in the future. That's a high rate. Tax rate risk, we all know on this, all of this group of us here, we know that taxes have to increase substantially, if not double, within the next 10 years. So there's tax rate risk, and then longevity risk. So what we're really trying to establish tonight is how best to answer that question of longevity risk. How long will my money last? And what if I live to be 95, 100 years old? So it's interesting. As I was preparing for tonight, I was reminded. Now, the fellow who came up with the 4% rule was William Benjamin. So he was a financial advisor and a young new financial advisor. Now, he was educated at MIT, so he was probably a really smart guy, or still is a really smart guy. So he was being asked by his clients, he says in an interview, how much money they need to set aside, how much money they can draw from the retirement to be able to make it through the retirement. So he did his own analysis over, I believe it was a 25, 30-year period of time, and he took different asset classes. And he determined that if clients don't draw more than 4% or around 4%, he's using a 4.2% number now, and then adjust that for inflation every year, given the mix of investments that they have, then they should not run out of money. So there are some concerns I have about that, and we're going to talk a bit about that as we move forward. But I want to give you some resources. So as you know, I like to share resources that you can find. And let's be honest, there's nothing out there that I have access to these days that anybody doesn't. So first, I'm going to share with you Investopedia. So let me pull up Investopedia, and that's a really good resource for folks to use for just about anything investment related. And it gives us some really good background on the 4% rule. So let me drag this down, and then I'm going to share my screen with you. And just raise your hands. Can everybody hear me okay? Raise your hand if you can hear me okay. Okay, great. Thank you. So I'm going to share my screen, and I'm going to show you what I see on Investopedia here. And this is a really great, so just raise your hand for me if you can see my screen. You should see Investopedia. Okay, great. Thank you, everyone. So this highlights the 4% rule, what it is, gives us some key takeaways. It tells the story about William Benjamin and how it came to be, the fact that we're accounting for inflation. You could see that he focused heavily on the severe market downturns in the 1930s and early 70s. People were very, very concerned about a repeat of the 70s today. And you should be, because there weren't many asset classes that did well in the 70s. And we're starting to see some familiar things, with higher inflation, higher unemployment, very concerning as we move forward. But don't let me get off topic here. So William Benjamin came up with this rule, and it's really taken off in different communities, certainly the financial planning community. And I hear people all the time citing this. Now, what I don't want folks to do ever is really use these rules of thumb. So this may be a good starting point, but we're going to dig in to how we should identify what a withdrawal rate should be for you. And it could be higher, it could be lower, and it all depends on what your needs are, when you retire, how many assets, what you have as far as assets, and how they're positioned. Really, most importantly, how they're positioned. So this Investopedia is a really good resource for you, but simply just know that William Benjamin, a financial advisor, came up with this 4% rule, but it was predicated on some returns. So the stock market returns, I think, were at about 8% at the time, is what he was thinking, and bond market returns were about 5%. And then you have to ask yourself, were bonds going to return at that same kind of level, 5%? Or are they going to be much lower going into the future, or even the near future for you? And then how about the stock market? Can we count on 7-8% returns for the stock market? You might think that that's possible. You might think that that's probable, and you might even expect it. But you've got to ask yourself these questions when you're considering something like a withdrawal rate, because if you withdraw too much too soon, you get in a position where you're potentially running out of money. And once you, that kind of happens before you know it, and you hit a point of no return, other than just hitting the brakes and stopping your spending altogether. And then there could be things out of your control that drive higher spending as well. So let's just set the foundation of the 4% rule was established by a financial advisor. It definitely had legs in the community, and you hear it all the time when you're referring to things or reading about things. It's in, if you just Google the 4% rule, you're going to see even articles from April this year, maybe even closer to that. People are always looking at this. There was actually, stand by 1 second. There was I just need to stop my share here or pause it. And there was another article while I'm pulling up my notes. In investment news, and I've got that right here. I think this was very, very recent. So even though investment news is kind of a trade magazine, this is actually February 2019. One of them I saw was was April. I've got one here from Barron's from January 23rd. But even though Investment News is kind of a trade magazine, again, anybody can access it. But this writer goes through and he talks about some of the concerns about the 4% rule. Then at the end, he wraps it up with, so yes, my answer is yes, the 4% rule can still work. Those are very, very dangerous statements. And I'm always concerned when I read articles like that and folks like Susie Orman and some of the other folks out there that kind of give this blanket advice for the masses, and they don't dig into what an individual investor needs. So there are definitely those articles still out there. Now, my friend David McKnight, he writes in his book that the 4% may not make sense anymore, and he talks about even 3%. But what I want you to take away from this discussion tonight is how individualized it really must be. Now, let me share this with you also. And again, I'm just giving you some background here from Barron's. So this is Mr. Benjamin himself. He's retired himself, but he went through and he talks about the viability of the 4% rule even today. So this is as of January 23rd of 2021. And he's still backing it up. And he actually says in here that he has since concluded that by adding a third asset class, small company stocks, investors could safely withdraw as much as 4.5% annually. It's a big statement, folks. But all that is still out there. Now, Barron's went on to say in that article, the author of the article, let me pause my share here and go back to my notes. I believe it was Barron's. Yep. They went on to say that in recent years, as interest rates have plunged, other researchers have estimated the safe withdrawal rate is now as low as 2.4%. So William Benjamin says 4.5. Other researchers say 2.4. Vanguard had produced a report many years ago that had that rate there at about 2.4, 2.5%. There was a time when the Certified Financial Planning Board of Standards had brought the withdrawal rate down to 3%, but now they don't have a recommendation at all. Wisely so, because again, you can get caught up in a false sense of security if you're saying, okay, I have $2 million, therefore I can draw $80,000 a year and adjust that for inflation. There's just so many factors that you have to look at with that. So let's talk about those factors. Before we move on, are there any questions about the origin of the 4% rule? Okay, I don't see any questions. So here are the issues the way I see it. So first of all, as I said, it's too general. It's much, much too general. If you retire with $1 million and some people can withdraw $20,000 a year, they may have pensions, they may have investment income, like investment properties, income properties. They may have a buyout from a company. Maybe they owned a business and they were getting bought out. So they may have other sources of income and they can withdraw a lesser amount. If they just said, okay, I'm going to withdraw 4% a year, they actually may be withdrawing too much, creating too much in taxes for themselves. There could be other issues. Now, someone else might say, okay, I have $1 million. I am told that if I have a mix of 60% stocks and 40% bonds, and I retire at the average age of 65, well, at a 4% withdrawal rate, I read in an article in Forbes that says that'll last 30 years. Well, that may not be the answer for you. You may not have a pension. Your Social Security may be taxed up to 85% of your Social Security may be taxed, making it where you have to take more and more money out of your IRA each year just to keep your expenses, level, keep up with your expenses. You can have many things happen. You can have a sudden expense. What if you have a sudden expense that you need? You need a roof, you need a car, you need, God forbid, medical care. Those are issues that don't really fit nicely into that 4% little window there. So it's way too general. Then you have sequence of returns risk. Now we go over this really in depth in our Changing World of Retirement class. We have another class coming up this fall. We're going to be doing an online class because I'm still uncertain about the availability of universities. But we talk about the sequence of returns risk. So raise your hand if you know what I mean about sequence of return risk. And I can almost tell you exactly who is going to raise their hand here. Well, for those of you who don't know, sequence of return risk is when you need to start drawing money out of your portfolio to meet your income needs, your expense needs, what you need to live off of in retirement. You better hope that the markets continue to go your way, because if you happen to hit a time when the markets go, your investments are losing money, then if you're drawing 4% a year, then adjusted for inflation, and you're dropping also, let's call it a modest amount, 4% a year, that's really slippery footing. It's almost like I visited the Grand Canyon several years ago, and I was amazed at the lack of barriers on the side of the canyon. So that's kind of neat to be able to see everything. But not only weren't there guardrails around, but there was a lot of loose gravel. So when you're in a situation, and I watched the guy come up to the end, and he was, I don't know why I remember this, but he was in sandals, and he came up to the edge, and it was kind of on loose gravel, and he realized how close he was to just this enormous drop off, and immediately pulled back. Well, it kind of has the same feeling to me of if suddenly you're dropping your portfolio, and maybe it's not too bad, maybe it's 4, maybe 5% a year, and you're withdrawing that 4% a year and then adjusting that for inflation. That's that slippery gravel that you just can't recover from, or it's very difficult to recover from. So if God forbid we get that in 1 year, 2 years, from the Great Recession, we had October 2007 until March 2009. That's a long time to be traveling down when you're drawing out money. That's really 2 years of withdrawals. And it could be worse than that, frankly. So then we're looking at historic returns. So we have sequence of returns. It's too general. We have sequence of returns risk. And then we're looking at these generalities around historic returns. So we're looking back over the past 20 years, looking back over 30 years. That means nothing for you. It's kind of an okay guide, but those historic returns are not your time period returns. Your time period returns are going to be the day you need the money and the day you die. That's going to be your window, right? So what matters most is how you're going to fund that timeline, not what happened prior to all that time. So looking at those historic returns from an academic point of view, it makes sense. It gives us a gauge, but it shouldn't drive your decisions. I hope that makes sense. We talked a little bit about large purchases. What if you need to buy a new home? What if you need to, do maintenance on your house? Maintenance can get very expensive, especially right now. We see a lot of increased costs in things like plywood. Everybody knows that plywood is an insanely expensive commodity right now. The cost of construction costs have come down a bit, but if you had to redo your roof this year suddenly, I think you'd be very, very surprised at what the cost will be compared to just a year ago. So large purchases, either unforeseen or planned, that creates an issue if you're just using that 4% withdrawal rate. You got to be very careful about that. I talked about long-term care risk. So I could spend a lot of time. I was with a prospective client today, and we were talking about the importance of long-term care. Hi, Roseanne. I see you raise your hand. If you have a question, just type it in the Q&A section for me. So we were talking about the importance of long-term care, and I shared with him the Genworth Cost of Care website. Genworth Cost of Care website is a really, really valuable tool. You can put in exactly where you live. It'll give you the cost of care today. Just a new thing seems to be the interest rate, or the inflation rate, excuse me. So you're going to want to adjust that. It defaults to 3, but it makes more sense to have 5% inflation on that. And then you can move the bar to represent the year, whether it's this year or 5 years from now, 10 years from now. So you can see the costs and what they're going to be in your area for in-home care, assisted living, and then nursing care. And it's always staggering. So it's just like I shared with you folks yesterday that I was going over some of the calculators on my website, and I was doing the college planning calculator with my daughter. Now I'm a financial planner. I've been saving for my kids' college for many years now, and she told me last night that no, Dad, it's not 4 years, or Monday night, I guess it's not 4 years that you need to pay for. It's 8, right? So we did the calculation for that on the calculator, and that's a staggering number. But long-term care is another thing that many people think they might have an idea about, but once you see the numbers, it can be really shocking. So there's long-term care risks also. So you have to be careful about that. Now, are there any other risks that anybody can think of? You can put it in the Q&A, but you can see how this just isn't using these rules of thumb. Just shouldn't be the guide. Is it okay to have it, kind of in the back of your mind? Maybe. It's good to be educated about these things. But again, try not to listen to these gurus who say, this is a kind of a one size fits all. This is a good plan. And you should use this, whether it's Barron saying 2.4 or whether it's, Benjamin's new 4.5. It's likely that neither one of those is right for you. So let's look at the solutions to these issues. Well, you're not going to be surprised to hear me say financial planning, first and foremost, is the way to find your correct withdrawal rate. I also am going to tell you that your withdrawal rate is going to fluctuate every year. It's going to be higher at some times. It's going to be lower at other times. Why do you think that if a retiree retiring at age 65 might have higher expenses earlier in their retirement and lower expenses maybe 5 years later? Why do you think that might be? I'm throwing that out for a question, so you can answer if you're so inclined. You can type it into the Q&A box. I'll pause for a second. Okay, I'm going to answer for you. Okay, we got somebody. Walter. Thank you, Walter. Walter says travel less, stay home. Yeah, exactly. You could have you could travel less when you're 5 years later and you're staying home, and travel more in the beginning is what I think you're saying, Walter, because you would have higher expenses, you higher withdrawal rate in the beginning. Don says vacations. Sure. Many people begin their retirement and they say, we want to spend, sometimes it's 3 times the average amount of vacation costs in retirement. And I had one client say, we want to spend about $35,000 a year for the first 3 years. And then we'll drop it down to about $10,000 a year after that. That's a really common discussion. How about Social Security? Many people, one of the questions they have for us is, when should I draw my Social Security? Now, sometimes it makes sense to wait until age 70. Sometimes it makes sense to draw it at your full retirement age, and it could be anywhere in between those two things. But what if you're one of those folks where it made sense to wait until age 70? Well, if you retire at 65 and you're waiting until 70 for your Social Security, you've got to live off of something. So that money's got to come from somewhere. So it's going to come from your investment portfolios if you don't have other income. That's going to raise your withdrawal rate. Okay, thank you, Roseanne. I just cleared that up. So Roseanne told me my screen states you started screen sharing. I had paused my screen. Now she just sees a small picture of me. So now you should see a big picture of me again. So Don's right. You're welcome, Roseanne. Don's right and Walter's right. There are certain things that we have that we want to do during those first several years of retirement often. And then often the spending is more, and then it can reduce down as we reach our 70, 75, 80 years old. Delaying Social Security, doing Roth conversions, paying for life insurance contracts. These are all things that we typically bring to the table. You might have ideas saying, well, I want to spend $100,000 a year. And then I talk about tax efficient planning. And I might say, well, how about we spend an extra $25,000 in tax and pay your tax now Well, that's going to draw up or pull up your withdrawal rate, isn't it? Surely it will. And what we see is when we have people shifting money to life insurance programs if they work for them, or paying their tax early, we'll see higher withdrawal rates, and then we'll see them dramatically drop after we get through the conversion period and the funding period for those life insurance policies. So that's another thing. I often joke with clients that, you have your idea of your retirement spending, and that sometimes can be overwhelming. Where's that money coming from? And we spend a lot of time in financial planning talking about that. Where's that money coming from, and how are we going to pay for that? And then you meet the team at Attleboro Wealth Management, and we say, okay, we want to make sure that you're funding everything that you want to do, but we also have these other things that we want you to pay for. And it's going to be beneficial to you, but sometimes it creates more anxiety about where those funds are coming from. So it's important for us to go through that financial planning process, identify those expense needs, and identify where they're coming from. And that is very specific. So that financial planning process is the number one part of the solution, number one step in part of the solution. Identify those expense needs, determine those funding sources, how we're funding those expenses, where the money's coming from, segment funding sources, and invest appropriately. So you've heard me talk about account segmentation. I did that, the discussion a week or two ago about the 3 pillars of investing, like asset allocation, principal protection, and account segmentation. You can find that video in a couple places now on our website if you missed it or if you want to review it. And then guaranteed lifetime income is a huge one. So as far as a withdrawal rate, if you're packing it, if you're drawing out more in the beginning of your retirement, the first 5 or 10 years, and then you have guaranteed income coming in from whether it's a pension, an annuity, again, sale of a business, income producing property, whatever they are, that's fantastic, right? So as long as that, and really the annuity companies are what guarantee the lifetime income for you, your spouse, or you and your spouse, depending on the structure, that can be really beneficial, and we see that drop down significantly. So with the idea of financial planning, what I'm going to bring you back to is our favorite couple that we're always talking about in these examples, and that's Frank and Joanna Miller. So I want to show you exactly what a withdrawal rate should really, really look like, and what it when you go through the process of financial planning, what it helps you identify, and what the reality of that withdrawal rate is. Now, Frank and Joanna Miller is a little different than our typical client, where their withdrawal rate, I'll just tell you, it stays pretty high. What we usually see is that we'll see higher withdrawal rates, 7-8%, 5-6% for several years, and then it significantly drops down. Again, for Social Security sometimes, or we're finished with Roth conversions. Now many of our clients have a guaranteed lifetime income stream that come from annuities at some point. Most of the time they're tax-free because we've done Roth conversions within those annuities. So that's fantastic too. But where did Frank and Joanna Miller come from, and why is it a little different? So Frank and Joanna Miller were embedded in our financial planning program, eMoney, as sample clients. And this time, just about this time last year, it was June 18th of last year, so about a year ago, we started talking about withdrawal rates, and I pulled up Frank and Joanna Miller, and I showed the financial plan. And we together, over the next several weeks, worked through a successful financial planning process with Frank and Joanna Miller. So we took them from running out of money, and I think age 85 or so. It's gotten better for them over the past year, but because we have true investments in there, and they are actually working in the sample. But we had them running out of money at age 85 without any mitigation steps, to where we took them fully funded to age 100 by going through the steps. And of course, the first step is identifying those expenses and identifying the sources. So let me give you the base facts for Frank and Joanna Miller. And it looks like I got logged out of my my financial planning system, so I'm going to have to log back in. It's really frustrating. I spent all this time getting ready, and inevitably something logs me out. So let me just get back in there. So let me give you the base facts of Frank and Joanna Miller. So again, these are sample clients, so I'm not sharing anything with you that I shouldn't. Frank is now 53. Joanna is now 54. No, excuse me. Frank is now 54. Joanna is now 53. A year ago, they had $1 million in invested assets and now have 1.2. Together, they earn $350,000 a year. Both want to retire at age 65. They want to spend $135,000 a year in retirement. That's $11,250 a month. Now, this is interesting because they just have a stated amount that they want to spend in retirement, and many people will come to us, and we have the questionnaire we have them fill out, and how much do you need in retirement, and they'll say something like, I need $11,000 a month, I need $5,000 a month, whatever your need is. And we have them go through the financial planning process, and we give them a spreadsheet that many of you have seen before and that you can pull from our website right now. That's actually going to change soon. We're going to kind of have a membership portal in our website where you gotta either be a client or some other kind of relationship with our firm to be able to access these resources as we build out the website. But today it is still available. So I'm going to share the website with you and show you my expense sheet. Now, those of you who are clients that work through this, you're very familiar with this. But I'm going to go into financial planning. And just raise your hand for me if you can see my website right now. It has financial planning. Excellent. Well, at the bottom of the screen here are some downloads. So you get these attachments. And the first one here is the expense worksheet out of our wealth management. And you're going to pulls up a spreadsheet. So this is a spreadsheet, and it went over there to my other screen. So I'm going to pull it back down for us. So this spreadsheet is a worksheet that we put together over the years. And we ask clients to fill this out the first time around and then every single year. The subsequent years, we send them their previous spreadsheet so we can compare, or they can compare them. And then when we receive it, we'll go through and we'll say, Don, your name's up there, so I'm just going to use you. Hey, Don, we showed $500 a month for dining out last year, and now it's $200 a month. Do you want to talk about what should it be going forward? And sometimes there's reasons for it. Sometimes there's no reasons for it. Sometimes it's just, I didn't realize that's bringing up to $500 a month. That sounds more like it. These are all really good conversations because we want to zero in on really what these costs are. Now, again, I've developed this spreadsheet and it changes often. I add things, remove things as we get feedback from clients, as we're using it, because, so it's been, probably at least a dozen years that we've been using this one expense sheet, and we've made changes. And what I find almost 100% of the time, and it doesn't matter how detailed you are. I have many people who come to us and they're engineers. They take really good, they keep really good records. They keep things in Quicken or some other program, and they'll tell us they need to spend $10,000 a month. We go through this and it's coming out to $12,000, $13,000 a month, because inevitably there's something in here that people say, oh, you know what? I didn't consider that. And that's not a gotcha. We're not trying to get you and say, see, we're just trying to really understand what you need and then identify those other costs. Let's talk about other expenses you may have. A really common thing is, well, we want to sell the house we're in and buy another house. And before we sell the house that we're in, we're going to have to do X, Y, and Z. We're going to have to redo the kitchen. We're going to have to redo the bathroom. And we identify those costs too. Other things that are coming up. I had a discussion with my wife this morning because I shared with you, I had to buy a new car. I hate buying new cars. I had to buy a new car for myself in November. I had to buy a new car for my wife this year. We got my daughter driving next year. We have my son driving this year. We're suddenly going to have all these expenses in cars that we haven't had in over a decade. So that's something we plan for as a family. Well, that also happens with you too, because if you're driving a car that's 5 years old, at some point, you're probably going to have to replace that or maintain it anyway. And We want to make sure that we're capturing all those big expenses, weddings, graduations, the things that can really take big amounts out. So identifying those expenses. So we use this sheet every single year as we go through it with clients. Okay, let me go back. So what we've identified with Frank and Joanna, just from a general point of view, $11,250 a month. Frank and Joanna want to collect Social Security age 65. We talked about Social Security election strategy. 65 is early for everybody. People sometimes disconnect retiring or they connect retiring and Social Security. That has to be done at the same time. Does not have to be done at the same time. So we went through Social Security selection strategies. We changed that on the for them it's to 67 and 60 and 70. And then we also went through, and I'll share with you that we went through some Roth conversions. So we had the 401ks and the 403bs, the retirement plans that they had. They planned to roll them over at age 59 and a half. And then we started converting those funds from traditional IRAs to Roth IRAs at $40,000 a year for Frank. And at age 66, we start at for Joanna, because we want to have them become tax efficient as well. So they're kind of the facts, and I'm not going to go through. I know you folks all know about Roth conversions, and if you want to learn more about Roth conversions, I'm sure there's a video in there somewhere. But you can ask me directly if you want to. And I didn't mention this, as always, at the end of this webinar, my calendar is going to populate, and you'll have the ability to set up a consultation with me one-on-one. Now, if you're an existing client, of course you can contact us anytime. You don't have to wait for a webinar. We'll schedule time with you. But if you already have something scheduled, like a financial planning meeting or something like that, let's keep that scheduled date, because we're doing a lot of work in the background to get ready for that. So there are the base facts of Frank and Joanna Miller. So I think you probably got a good idea now where Frank and Joanna Miller sit. So now let me bring down their financial plan for you. So I'm going to bring their financial plan down for you. And I'm going to share my screen once again. And here's where we're going to get back to that withdrawal rate. So let me ask you again, raise your hand if you see something that says Frank and Joanna Miller sample. Thank you. Now I'm sharing with you kind of the back end of our financial plan, but I can go into their website and show you what it would look like for a typical client. And we can work from there, I believe. I may have to come back, but we can work from there. So if you're a client, you're familiar with this. When you log on to your financial planning website, this is what you see. And there's lots of reports here. So a couple things we're going to do, and I am going to go back because we're working on an alternate plan, I believe. Yeah, so we're going to go into reports, which you can access either via the client website or our website. And this is spinning. Okay. And we want to see, first of all, cash flow. And this all gets to the withdrawal rate. And this is why it needs to be very, very specific, because without, first of all, going through that expense, that work, it is work. We've got that 8-week process of financial planning. Remember, we have a discussion about what this process is going to look like, what your responsibilities are, what our responsibilities are, our roles and responsibilities. The second meeting is taking all that information that we've gathered from you, all of your statements, all of your life policies, your different insurance policies, your property and casualty policies, everything, and digging into those expenses, looking at any income you have, any assets you have, looking at everything. And then in that second meeting, we get together to make sure that we understand everything the same way, the way we should. So, am I understanding that you have $20,000 a year of rental income, that you've got this 401k over here, and we can transfer that out or we can't transfer that out? So there's a lot of questions along the way. And then we go through, well, what about these expenses? Does this mean this, or is it written another way? And you've given me a mortgage payment. Does that mortgage payment break down principal and interest? So we really dig in and get that information. The third meeting is when we come back to you and we say, okay, now with all this information that we have, These are the recommendations. I call it the solutions meeting. We give you the solutions. This is how you should be invested. This is what your funding should be, where your funding should come from at the different times of your life. These are the Roth conversions, if that makes sense. How we should fund life insurance, if there's any annuities involved. We go through and other investment processes. Number 4 meeting is typically estate planning. We can change that around as much as we need to, but that's usually how it works. So we've dug in with Frank and Joanna Miller. You know the base facts. Let's look at their cash flow. So this is looking at exactly how they're predicted to over their lifetime. Now, I told you that, look at this mountain chart here. So they're earning, retire here at this line, and this is when we have the drawdown. Now, I told you that it's gotten better for Frank and Joanna Miller, but they still run out of money at some point. And I'm willing to bet that the adjustment to Social Security is what made it better. But at age 95 here, let me show you explain what I just popped down here. So this chart shows the year. This is year 2021, of course. This is the ages of Frank and Joanna Miller at this time. Their income flows, what they have coming in together. That's very general. Their total expenses, this is what they told us they spend. This is what they're saving, $29,500 a year. So their outflows, their expenses plus their savings is $373. So they're already at a $23,000 deficit. You'll see that deficit clears for a bit of time after they're 59 to 58 years old. We have another big expense here. I don't quite remember what that expense is, but you'll see it jumps here. So I'm on the right-hand side. And then you'll see their total portfolio assets. So that increases over time, hovers after they retire. This blue line represents their retirement. And then we start withdrawing from the portfolio, 122,000, 123,000. And they run out of money. You see the portfolio gets drawn down here all the way at age 96 and 95. Now, some people might be a little glib and say, well, geez, that's okay. I won't be here then, or I won't know any better. But I'm here to tell you that there's plenty of 96 and 95-year-olds still out there today who are counting on their money. And we're talking about 1963, so several years from now, right? So 42 years from now, there's going to be a lot more 95 and 96 years old, and it might be you. And you don't want to be in a situation where you're at $178,000 deficit here, because simply that means you're only living off of your guaranteed income, and that's probably Social Security for most people, if you don't have any annuity policies, pensions, or other income. So we, of course, want to fix that for Frank and Joanna Miller, and we did that a couple of different ways, but I'm going to share with you, this is kind of you're kind of seeing how the sausage is made, but this is the back of it. So here is tax efficient only. So that should just be with Roth conversions, but just with Roth conversions, not even segmentation. It's fun that. Look at that. We closed the gap just by making them more tax efficient and erasing some of that tax that they pay. Now, this is a great program, but what it doesn't do well is show an increase in tax over the long run. I can do an increase in a certain window, but if we go back to the original, let me go back here to what's called the base facts before there's any changes. This doesn't take into account the doubling of taxes. So if we're here in 2031, and now suddenly they're at a 40% effective tax rate, like we believe most middle-class Americans are going to be, they're going to run out of money much sooner. That's where it gets them to age 85. They're probably at a zero, if not before that. So the first thing that we want to try to do is make them tax efficient. So using Roth conversions only, we bring that in that tax efficiency, and we get them to where they still have money at age 100. They have $737,000. So that's good. Now this is just a this is a linear projection. This is where financial planning used to kind of start and stop. Now we use Monte Carlo simulations. Now, of course, if I used a Monte Carlo simulation and on the last example where they were running out of money at age 95, that's going to show 0% or zero chance that they're going to meet or exceed their goals. Now, what is a Monte Carlo simulation? A Monte Carlo simulation is a probability of success. So in the case of this program, it looks at it, runs 1,000 different scenarios based on the information we give it, and it tells us the probability of success. So actually, let's do it. Let's do it for this. We know the previous one before we made them Frank and Joanna Miller tax efficient had no chance, but we can see what it's going to be here, and I can do it. Let's do it here because it'll be a little better to look at. Oh, we already have some of them built in here. So these are, you'll see these running here already. So this is interesting. So that current situation, as I said, no chance, 49% is not good. If I told you that you had a 50% chance of meeting or exceeding your goals, that wouldn't be good. So that's basically zero. This is, let's see what this is. Tax efficient. With life insurance, we determined with Frank and Joanna Miller that we could not use life insurance for them. We're going to add tax efficient only, and let's see the probability of success on that. I assume it's going to be greater than, no, that's only 86. We're going to have to work on Frank and Joanna Miller a little bit, or 66, excuse me. We want better than 82%. So if Frank and Joanna Miller were real clients, we would have to either talk about reducing expenses, making some changes in their allocations. Perhaps we answered this with segmentation, but that's an interesting look. We wouldn't want to maintain that for an existing client. That's really interesting. So that's Monte Carlo. So even though, and what we just saw there is interesting, because even though this linear projection, let me go back to this. Even though this linear projection, and this is what I'm talking about, linear, right? We've got expenses that grow at a rate every year. We have income that grows at a rate every year. And then we have projected returns for the portfolio they're growing every single year without any decline. Now, the Monte Carlo simulation looks at the ebbs and flows of the market. So even if you look at this, and many people make this mistake too, so I'm really glad we're seeing this. You run your program on Vanguard's website or whomever's, and I'm a fan of Vanguard. I use them for investments. And you say, okay, by the time I'm 100 years old here, I'm going to have $1 million left. I'm good. I'm good with spending when I'm spending. But when we flip back to, what we just saw with the Monte Carlo simulation, let's go back to here. We still have an issue here. So we would build on that issue. Maybe that we talk to them about working part-time in retirement, or, there's a lot of people who they want to retire from their job at age 65, but just carrying a part-time position, $25,000, $30,000 a year can make a big difference. So that's really interesting. And yes, part of the funding is they need to pay, they want to pay for their kids' college funding here. So let me go back to this other report, and I want to show you a different way to look at Monte Carlo, because I want to show you the swing of the probabilities. And we're going to go back to, all right, now that's running. Okay, we're going to go back to tax efficient only. Now this is the less pretty way, right? It doesn't have the graph and they show the probability of success. This is just running through the scenarios, and it still shows us the same 66% of the time here. But you can see here the different spreads. Oh, it's running it again. Every time I click to a new link, it's going to run it every time. So you'll see here that the maximum that they had was $29 million in portfolio assets. The minimum was negative 97, and the average $3 million to $6.9 million. And that's running 1,000 different scenarios. So that's taking into account various returns. Sometimes they're up, sometimes they're down, just to put it very, very simply. So this is the best measure we have of what the potential success of a portfolio is going to be. Now we're going to take it another step further, of course, but using that, knowing that we have this cash flow projection showing us that they're going to still have $900,000 when they're still when they're 99 and 100 years old, right? $958,000. But we still have an issue filling up the gap with that Monte Carlo. Let's get back to the withdrawal rate, and let's look at these detailed withdrawals. So this is more real world. So I want to bring it back down here. See this withdrawal percentage, and I'm going to move forward to their retirement years. So I'm just clicking forward 5 years. So here is 64 and 63. They don't need any additional withdrawals. See this 0? Because they're still working, they're meeting all their goals and through their income. Now their first year of retirement, here's where they need to withdraw 5.42% just to keep just to fund what they want to fund. That $11,250 a month has now grown with inflation to a significant amount higher. So they need to take $145,000 a year out of their investments. The following year, it's greater. You can see where it comes from. They've got their joint investments here, $168,000 from their joint investments, $13,300 from their from Frank's traditional IRA, and that totals $182,000, and that's a 6% withdrawal rate. Move forward 5 years, you can see 9%, 9%. They continue to be at 9%, 8%, 7%. See here, it drops down at 5.62. Now they would need to come down, and Frank and Joanna Miller were live clients. Again, I wouldn't be comfortable with that 66% probability, but you can see here where it drops down. Now I got to tell you, these withdrawal amounts, 9%, 8%, that's too high for most people, unless you have significant assets and you're already earmarked assets for future use, and that's account segmentation. But you can see how we have these drops, because 5.62 to 4.70. Let's see what it looks like in the next 5 years. So they're at age 74 and 73, 75, 74, and 76, 75, 77, 76. So you see it, they're hovering right around the high 4s and into the 5s again. That the cost of living continues to go up. This is really, really interesting. But this is common, folks. So if Frank and Joanna Miller just said, I'm going to draw 4% a year, and we're going to take that. Well, first of all, they're going to have to make adjustments to their retirement structure, and it just wouldn't work for them. Now, there are things that they would have to do, Frank and Joanna Miller, to close that gap, as I said, at 66. But this is a real world example of what a normal, well, they're abnormal, but the typical fluctuations we tend to see, they stay high. What I usually see is when, and I wish I could show you an existing client, but of course I can't do that. Maybe I build out a sample client that works a little bit better. But I like seeing these challenges because, first of all, we closed that gap. Now, one of the things I think we're going to have to do with Frank and Joanna Miller, and maybe we'll do this together, is we'll balance this and make this all work for them, even with that Monte Carlo. But you'll see here that what we normally see is right around the end of the 60s, early 70s, this drops down significantly. When somebody retires at age 65, that's usually when we start seeing an annuity income stream come in, Social Security, or some other Roth IRA withdrawals, and typically these drop down to the single digits, 2-3%. All right, let me pause there and see if we have any questions. All right, no questions. All right, let me stop my share for a moment. So what would we do with a situation like Frank and Joanna Miller, and how could we help them? Well, go back to the funding sources. We know the three pillars of investing: asset allocation, principal protection, and account segmentation. We want to also talk about guaranteed income. So we could create a segment for them, take funds and put them aside, and have a guaranteed income stream coming from the something like an annuity. Now, let me see if we have that in here. No, that's interesting. So one of the things that we would certainly want to do is figure out how much we could set aside for Frank and Joanna Miller in an annuity, and have that grow, and hopefully grow tax-free through Roth conversions. And at some point, that's going to give us guaranteed income. And if you remember, I actually had that portion not in the financial planning program here, but in one of the advanced classes where we showed how we took away the negative years by principal protection and using principal protection, and then we had income flows. So that would make a big difference. And that could be where we see at age 70, maybe even, depending on if we were able to roll those funds over early enough, we might even be able to trigger that at age 65, but let's just say age 70. And yeah, actually today there are some platforms that let us take the funding a little bit earlier. So it could be at age 65. If we had a guaranteed lifetime income stream, that of course is going to reduce that withdrawal rate. And maybe even if it doesn't reduce it early on, it'll help reduce it as we go into the following years. So guaranteed income is very, very important. And then of course, segmented investing. Segmented investing is going to help because it's going to give us the assets that we need in certain pockets along the way, early in those early years, and protect them against that market risk, and allow for a higher return later. Excuse me. Because what many people do is they make their entire portfolio too conservative, even if it's just the entire portfolio is moderate and it's not giving them the gains that they need over their lifetime. So that is the general idea with the 4% rule and the reality of the 4% rule. So I'm hoping that you can see that it is different for everybody. Frank and Joanna Miller show that they're, well above the 4% rule, and they need work to make that work. It may be that you collect from your investments a withdrawal rate of 7%, 8%, or 9% early in your retirement, and then it drops down. Now it can start higher, drop down, and then rise up significantly. Does anyone have any idea why it may rise up again later in life? So let's say if your withdrawal strategy, let me whiteboard this, make it a little easier, at least for me. Roseanne, I see your question. I'll get to that in a second. I'm waiting for my whiteboard to open up. Okay. Okay, so I'm going to be looking down as I draw this, but I just raise your hand for me if you can see my whiteboard. Okay, so we're talking about withdrawal rate. Now let's talk about typical retirement age 65. Let's give our timeline, and let's just take this to age 95. So we talked about why it may be higher in these beginning years. So let's say you've got a 6%, you've got a 6%, and you've got a 6%. Now for most people, 6% is not sustainable. If that continued for the rest of your life, 6% may be high. You saw the effect on Frank and Joanna Miller's plan with those high withdrawal rates. They've got a large need, $135,000 a year adjusted for inflation, with just $1.2 million saved. And you've heard me say before, $1 million is a dangerous amount of money because it sounds like a lot of money. It is a lot of money, but it's not enough, as you saw, to sustain $135,000 a year. So in the beginning, you may have a 6% withdrawal rate. We talked about it, the onset vacations. You might be doing Roth conversions, funding a life insurance retirement plan, to get tax-free distributions later. You might be purchasing a new home. There's a lot of different things you could be doing in those first few years. And then you could have, let's get rid of that. And let's say year 5, right? So now we're 70. That could drop down to 3%. It really could have, right? Because you could start then taking Social Security. That is not a recommendation. That's different for everybody. Some people might take Social Security at 66. Some people might take it at 68. You might take it at age 70. That might drop that down. You might also have purchased or invested in say a fixed indexed annuity here at age 60. Many people roll over their 401k plans after 59 and a half. They roll into an IRA. They put the money into a fixed indexed annuity, and then they convert it to Roth. That's one of our strategies. And now you might be able to take, some people take, $35,000 or more out of those annuities every year. That's just an example. So that may reduce your need. And of course, if it's Roth, it's zero tax, as long as it's been held the appropriate time and all the requirements. You may also take Social Security at that time, and that would drop it down. It could even go less. It could go to 2%. And you could kind of hover around there for a while. And then we're going to make 95 way over here because we're encroaching on 95. So now let's say at 85. So you do this for a while and you're in the 2s, the 3s, and it does fluctuate every single year. And you should review this how often, folks? Well, every one of you should be saying once a year because you should be reviewing it once a year. And Ken just said it. You could hit medical issues. What happens here at age 85 if suddenly you need long-term care? Well, we talked about the general cost of care. And as I was going through it today, today's rates might be $11,000 a month. And in 20 years from 65 to 85, that could be more like $18,000 a month or higher. And that might bring your withdrawal rate back up here to these levels, right? 6%. It might be even higher, 8%. So you're going to definitely see ebbs and flows of your withdrawal rate. So if you're just counting on a 4%, 4.5% as Benjamin now says, 2.4% as Barron say, or anywhere in between, you're not doing yourself any good because you're landlocked on these numbers where in reality, you need to identify what it is for you, see if changes need to be made like Frank and Joanna Miller, or just see what the net effect is going to be over your lifetime. Because as you see these withdrawal rates ebb and flow in your plan, you can project it out. And in Frank and Joanna's case, when they're no longer here, they had $0. That may be acceptable to you, and it may not be. You might want, well, let's make sure there's $500,000 there. You might say, let's make sure there's $1 million there. We don't know that without doing all the hard work and all the work that's involved right in the beginning, right? This is where it all starts in the beginning of financial planning. And then every step of the way in your retirement, every single year, you should be looking at it. And I'm not exaggerating. Every year you should be looking at that. Identify expenses, identify resources, identify sources and how they're going to fund. And that'll give us your withdrawal rate. So we don't want Benjamin's withdrawal rate. We want your withdrawal rate. No disrespect to Mr. Benjamin. He did a great thing for the industry and for retirees, if nothing else, to trigger these conversations. But you want your withdrawal rate. Folks are going to write about this as long as I'm doing financial planning, as long as I'm alive, because it is a big hit item. I spent some time with an SEO person, search engine optimization for our website. I'm really excited about the changes on our website. And we get actually good hits, which surprised me. But, and the more content we put up, the more that grows. So that's really neat. But these certain articles or certain things, I just did that funding annuities in retirement, and that's becoming a very popular pool for our website. That is such a small part of it. But 4% withdrawal rate, that's a common Google search. So the people who write the articles, they know that, and that's they focus on these things. That's why it's regurgitated over and over again. But focus on your withdrawal rate, and the only way to do that is to go through this financial planning process. All right. Roseanne asked a question: can you hold an annuity in an IRA? Do you have to pay income taxes on the guaranteed income? Those are really good questions. So can you hold an annuity in an IRA? Remember our buckets. We have our taxable bucket. We have our tax deferred bucket. And we have our tax-free or tax advantage bucket. So IRA sits here, doesn't it? And in tax deferred. So just remember your taxable. This is anything that generates a 1099 on an annual basis where you pay tax on it every single year. And that's interest, dividends, long-term capital gains, short-term capital gains. And your IRAs, your 401ks, your 403b plans, any retirement plan, anything that you've promised that you're going to pay tax later instead of paying taxes today sits in this tax deferred. Tax-free are truly only Roth, anything Roth, or properly structured cash value life insurance, or sometimes called life insurance retirement plans. I like this term. I know Dave McKnight likes that term, but they're really the same thing. So to Roseanne's question, can you hold an annuity in an IRA? Absolutely. And in my opinion, that's where it should be held. The question is, which IRA should it be in? Should it be in a Roth IRA or should it be in a traditional IRA? Well, ideally, we want everything in a Roth IRA, don't we? We have a certain amount of money we want here to pay, our expenses. That should be 6 months to 1 year. You can sometimes keep money in an IRA and pay zero tax, and everybody should determine if that works for you or not. That's very specific to an individual. And anything else that is above this and above this, you should fill up this bucket. So ideally, if you could buy an annuity in a Roth IRA or fund an annuity in a Roth IRA, that's where it should be. Unfortunately, most people who come to me and they have annuities, they're either in this bucket or they're in this bucket here. If they're in this bucket here, it's really challenging. And it can also be challenging in this bucket, in this tax deferred bucket, because there's only 2 companies I know of that allow us to take money from a tax deferred traditional IRA and convert it, talking about Roth conversions, to a Roth. Now, what I say that one of the reasons that we use annuities is because they have certain guarantees associated with them. Many and most IRA annuities will say, yeah, you can convert it, but you give up the guarantees that we've given you, at least for the portion that you convert. Or they require you to do it all at once. There's these crazy things, but there's only 2 companies I know of that will allow you to, David McKnight calls it piecemeal convert from traditional IRA to Roth IRA. If you put annuity funds into this taxable bucket, it creates a whole new tax deferred entity that we just don't want, because our strategy is to reduce the amount in tax deferred, I'll pay that tax later money, and pay the tax now so that we can enjoy zero tax and reduce the risk of higher tax in the future. Because when we tell the IRS that we're not going to pay you now, we'll pay you later, we're paying the I don't know tax. And that certainly will be higher. Remember, our studies show 40 to 45% effective tax rate for most middle-class Americans within 10 years or more. Now, interestingly enough, I shared this yesterday. I was listening to one of David McKnight's recent podcasts. David believes that the Biden administration is going to extend the Trump Tax Cuts and Jobs Act for another 8 years for anybody earning under $400,000. Ed Slott feels differently. I haven't spent much time to see what others are saying about it. I think it's really an interesting concept, and I hope David's right for our client's sake. If those tax cuts are extended over the next 8 years, it's really a brilliant political move. But for our client's sake, that gives us more time to transfer assets from taxable to tax-free. Roseanne, I hope that answers your question. Okay, any other questions out there? All right, so what we covered tonight was the origin of the 4% rule. I hope I gave you some resources where you can look at this on your own if you want to. You'll be able to review this recording again. We discussed some of the issues surrounding that 4% rule and why I believe it's really not appropriate to use any rules of thumb. Listen, we hear them. Take your age. This is one I've heard, and you've probably heard. You take your age, and that's the amount. So if you're 60, you should be 60% in bonds or safer investments. That's a terrible rule of thumb. Don't follow that rule of thumb. Don't withdraw more than 4% of your assets during your lifetime, and you won't outlive your assets. That's a terrible rule too, in my opinion. Because what about sequence of return risk? What if you have significant drops in your portfolio? What if you have significant expenses? There's a lot of issues around that. So we talked about some of those other concerns, and then we talked about solutions. The solutions are identify your own rate of withdrawal risk. Make sure you're using the pillars: asset allocation, principal protection, and account segmentation. I've told you that everybody does asset allocation, whether they do it well, everybody professionally, whether they do it well or whether they do it poorly, that's a whole other discussion. Many folks use principal protection, some type of protection, whether it's a structured CD or a fixed indexed annuity. We've gone into those before. Some people still use variable annuities. Very, very, very few people are using the account segmentation because, as I told you, that is plowing the field with the ox, pulling. You're doing everything by hand. It's a tremendous amount of work, but it is worth it, and that could be the difference for Frank and Joanna Miller between account segmentation and a guaranteed income stream. So if you apply the 3 pillars and add in a guaranteed income stream, and that income stream could be from an annuity with a lifetime guarantee. An income stream could also be from a life insurance retirement plan. Now, they're not guaranteed for your lifetime, but we stress test those to go out to 100, 120 years old. Now, again, they're not guaranteed like an annuity is guaranteed, but when you pull those 4 things together, that can help identify where those risks are for your own withdrawal rate, and then you make adjustments as you need to. And how often should you review that plan? I hope you're all saying every single year. All right, folks, it is 7:43. I hope this was beneficial to you. I hope you learned something tonight, and I look forward to seeing you all again on Tuesday. We have a webinar this coming Tuesday, and then our next special webinar is going to be on August 25th. And this wraps up the marathon of June and July webinars. But I hope you all enjoyed it, and I hope you have a great rest of your Wednesday night. Thank you. Take care.
Hello again. I hope you enjoyed the video and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.